The Global Financial Crisis, an in-depth exploration. The 21st century has borne witness to a plethora of unprecedented events, but few have had such a profound and lasting impact as the Global Financial Crisis, GFC, that erupted in 2007 to 2008. This catastrophe shook the world's financial systems to their core, and its ramifications are still palpable, even years later. At its crux, the GFC stemmed from a combination of factors interwoven intricately in the fabric of modern economic systems. The most conspicuous of these was the U.S. housing bubble and the subprime mortgage crisis. The term subprime refers to loans made to borrowers with a less than stellar credit history. While such loans inherently carry a higher risk of default, they were nevertheless packaged into securities and sold to investors around the globe. In the years preceding the crisis, there was an uncritical optimism, which saw housing prices soar in several countries, most notably in the U.S. This was buoyed by easy credit conditions, facilitated by an abundant global pool of funds. These funds found their way into riskier assets, like subprime mortgages, in search of higher returns. The financial instruments, however, became increasingly complex, obfuscating their true risk. Financial institutions, eager to capitalize on these high returns, became heavily entangled in these toxic assets, with many top-tier banks exposed to the impending risk. In 2007, the bubble began to burst. Home prices in the U.S. started to plummet, and defaults on subprime mortgages began to surge. These loan defaults initiated a cascade effect on the securities tied to U.S. real estate pricing, inflicting significant losses worldwide. With a catastrophic domino effect, major financial institutions across the globe found themselves facing unprecedented liquidity shortfalls. To understand the magnitude and interconnectedness of the crisis, one can examine the collapse of the investment bank, Lehman Brothers, in September 2008. A stalwart of Wall Street, its fall sent shockwaves around the world. Unable to find a buyer or secure government bailout, it filed for bankruptcy. This event created an unprecedented panic, causing credit markets to nearly freeze up. Central banks worldwide, recognizing the gravity of the situation, leapt into action. Interventions included lowering interest rates, implementing quantitative easing, and offering liquidity to ailing institutions. These efforts aimed to mitigate a total financial meltdown and restore faith in the system. Governments, too, played a role, with several, including the UK, nationalizing or bailing out their banks to prevent systemic collapses. While the immediate financial impacts were dire, the GFC also birthed an economic downturn. Several economies entered into recession, unemployment rates swelled, and global trade contracted sharply. Recovery from such deep recessions was arduous and slow-paced. The GFC also precipitated significant socio-political consequences. There was a discernible erosion of trust in institutions, be they financial, governmental, or media. In the post-crisis era, sentiments of disenchantment and disillusionment ran rife. The public felt let down by those entrusted to safeguard their futures, engendering a wave of populist movements across many nations. From a regulatory perspective, the GFC was a critical juncture. The crisis spotlighted the inadequacies in financial oversight, catalyzing reforms in both national and international spheres. New regulations sought to shore up bank capital requirements, improve transparency, and reduce the risk of another crisis. Instruments like the Dodd-Frank Wall Street Reform and Consumer Protection Act in the U.S., and the formation of regulatory bodies such as the Financial Policy Committee in the UK epitomized these reforms. Yet, as we reflect upon the GFC, the question arises, have we truly imbibed the lessons it offered? The crisis underscored the dangers of unchecked speculation, excessive leverage, and complex financial products. While regulations have tightened, it's crucial to remain vigilant. The nature of financial markets is such that new risks will continually emerge. In summary, the GFC was not merely an economic event, it was a defining moment in the history of global finance. Its lessons are manifold: the importance of robust financial regulation, the perils of complacency, and the interconnectedness of global markets. As we move forward, it's imperative to remember and learn from this tumultuous period, ensuring that future generations are better equipped to navigate the intricate world of finance.